Good morning, my name is Przemysław Kwiecień, I'm Chief Economist of the XTB. It's my pleasure to be with you this morning to discuss the markets and what's in store for this week, but also what's in store for the global economy in 2021 and beyond, as this is the story of the week for us today. But before we get there, let's start from covering key markets and top news on Monday morning. First of all, the dominating factor is certainly market euphoria that continues to really impress after the vaccine news. Last week we had Wall Street recording another all-time highs on pretty much all the key indices, despite two, you'd think, negative factors, one being a surge of pandemic, which in Europe it seems to stabilize, it seems to improve a little bit, whereas in the US the statistics are pretty nasty at the moment and more restrictions are being implemented. But that's being kind of ignored by the market that seem to think that, well, with vaccine in the pipeline we no longer need to be concerned about it. The other factor was the NFP report on Friday, which was relatively weak. I'll turn to this a bit later in detail, but for now let's see the table on the right, and it says that employment growth was 245k, which was pretty much around half of what's been expected, and a clear disappointment which didn't prevent markets from rising significantly on Friday without any additional reason. So for sure there was a lot of market euphoria out there. US dollar stabilizes after a period of weakness, a period that was augmented by euro dollar blowing past 120 and paving, you'd think, its way towards even higher levels. We'll take a look at this shortly. OPEC Plus decided to increase output, although very gradually starting from January. The fear was that with the vaccines and with the economy bound to rebound next year, oil production will increase as well, putting pressure on prices. So the OPEC obviously doesn't want that, so they wanted to make sure that this increase in production will be slow, and this is another thing we'll discuss in a minute. Strong recovery on gold. Last week we discussed whether it would make sense to buy gold at the levels that we had, and it seems that it, at least in the short term, that made sense, that gold recovered quite nicely. Crypto a bit off the radar, at least compared to what we had 2 weeks ago, but Bitcoin still close to 20k, so it's quite possible that more will happen there. And calendar for this week is Bank of Canada Wednesday, ECB the key event of the week, ECB on Thursday, and US inflation again on Thursday. So you'll say maybe not so intensive week from a calendar point of view like we had previously, but still these events are worth watching. So let's start from indices and the call options story that I want to turn your attention to. On the right, the chart, very long-term chart showing you S&P 500 deflated with CPI. So you have a real inflation-adjusted index, and you can see that compared to some regression line, which is in red, the deviation from this line is at record highs, which means that from this, at least from looking at this measure, US stocks are the most overvalued in history. Well, you could say, well, it's just one measure, but frankly speaking, if you're tracking my webinars, you would see that each week I present you another measure, and nearly all of these measures suggest the same record overvaluation of US stocks, and you really need to work hard to find measures that imply that this overvaluation is not substantial. So that's something certainly worth watching. But while such record under overvaluations can take time to unwind, this thing on the left is certainly worth watching in the shorter term, as well as speculation, as there is speculation that there is a lot of froth in stocks options. Last week, put-call ratio for the S&P 500 was the lowest in decades, and it says that just investors are aggressive buying calls and do not protect their portfolios buying puts. But while the index, the ratio for the index is one thing, the story suggests that individual investors are aggressively buying option calls, and the risk is out there because if individuals buy call options on equities, then brokers need to hedge and they need to buy equities to protect these positions. So if for any reason, so obviously right now this inflates indices, but if for any reason like we had in September, if these individual investors became scared by something, they will abandon these trades in a rush, probably leading to a very rapid correction. So this is something that you certainly want to keep your eye on. And if you look at indices, you can see that if you draw a line between the highs from January 2018 and pre-pandemic highs and September of this year, the situation that I'm discussing, that we also had a lot of call option mania here, and as you can see, that led to a very abrupt correction. So right now we are actually above this line. So obviously from that perspective, the market is very, very, very hot, and certainly if there is already a suggestion that these options are very active again, so this is something that you want to have in mind. All right, moving to Forex, euro dollar rallied below past 120, and now the question is, can we repeat the story from 2018? Well, there are many similarities. If you look at this chart, you will see that first of all you also had a very substantial rally, then a consolidation like previously, like this, very similar to what we had here, and then once the euro dollar blew past the upper limit of this consolidation, it rallied very quickly above 125. So just painting a similarity here, we could go as high as 126 right now. So obviously there is no guarantee that's going to happen, but there are many similarities. Back then also markets expected strong economic growth in Europe, which turned not to be the reality, but at least the expectation was there in 2018. We also had options speculation on Wall Street, again like something that we have right now, and as you can see, we had high CFTC net speculative positioning on the euro. So many factors look very similar, and while fundamentally there seems to be no reason to expect significant rally on this currency pair, in the short term on market, many things may happen, and it's just something that you might want to be open to. Okay, moving on to the OPEC and oil. Well, the decision basically is that OPEC will increase, OPEC Plus with Russia will increase outputs at very moderate 500,000 barrels a day level from January, and then for another 3 months. So this output increase that was about to occur at the beginning of next year will be kind of smooth over the first 4 months of the year. So from that perspective, that's good news for prices, because that means that the market will not be overwhelmed with output. And as you can see on this EA forecast, it means that with consumption already recovering, production will be below the demand for some time at least, paving the way for stabilization of the oil market. Then again, there's a lot of optimism regarding prices already, even though prices rallied quite substantially. You can see the Goldman Sachs predicts Brent to close next year at 65, which is another 30% higher than what we have right now. And as you can see here on the chart, yeah, we had this panic, second wave of pandemic panic here, then very strong rebound partly on the vaccine news, and the latest path was already above the levels from late August. So a strong rally to be sure, and a bit like indices, this market seems to be a bit overheated already. So even though there's a lot of optimism, even though this OPEC decision seems to be relatively supportive for prices, bear in mind that the market is overheated, and a stronger correction could happen should we have mood deterioration on a broad market. All right, let's move for the story of the week. What's next for the economy in 2021 and beyond, I think, because that's what's going to happen beyond, to me, is probably even more important than next year. Why? Let's start from the OECD forecast that we had released, I think last week. As you can see, 3 years, this year is pretty much done. We still don't know for sure how precisely fourth quarter will look like, what kind of damage we will see due to this second wave of restrictions, but more or less it's going to be that way, right? That we will have probably in most of the countries, most of the areas will have significant contraction throughout the whole year. So that's already in stone. Next year, I think there is a lot of optimism that we're going to see a strong recovery, and I think it's much warranted because first of all, we'll finish this year on the weak side. So once the economy reopens again, it will naturally have the tendency to rebound. That's the first thing. Second thing is that we had record stimulus applied, both monetary and fiscal, and again, this stimulus is already supporting growth this year, which means that the contraction is not as big as it could be without this stimulus. But also next year, when we're going to have reopening, when we're going to have broad access to vaccine, people will be more eager to return to normal life, and they will take advantage of this stimulus, and therefore economic growth is going to rebound. But the question is, what happens next? Because as you can see on this chart, the OECD predicts 2022 to be nearly as good as 2021, and actually for some countries like the US, they predict that 2022 to be even better than 2021, and I wonder why. Why do I wonder? You could ask. Well, starting from present data, you'd think that everything looks bright. The activity PMI data, it looks really solid. We had only slight deterioration in November due to these restrictions in services, but the industry looks really good, and you would think that only paves the way for strong economic growth once a vaccine becomes broadly available. However, bear in mind that this year will end up in record increase to public debts pretty much everywhere. On this chart, you can see the gray bars are the levels of the debt to the GDP, and these orange rectangles are increases in percentage points. So you could see from these orange ones that for Greece, Spain, Italy, and Japan, you have increase debt to GDP increase of about 25 percentage points, which is absolutely staggering. And for other countries like Belgium, France, Portugal, US, and UK, you have increases of around 20%, which is also very massive. So what does it mean? First of all, of course, these increases happen for two reasons. First of all, as the economy contracts, there is less revenue. But also, as we know, governments responded to crisis with huge stimulus packages nearly everywhere. And of course, this helps cushion recession, and this will help drive growth next year. But of course, this stimulus is only temporary, and obviously after it wanes, the question is, what's next and how the economy could possibly grow as fast as next year in the longer run when this stimulus fades and we are left with such a indebted government. That's, from my point of view, that's nearly impossible. I did a presentation a few weeks ago showing that above 90% in debt to GDP ratio, there is significant burden of economic growth, whereas you can see that already this year will end up for many relevant economies, maybe except of Germany, above this level. So already it's going to be a trouble, and next year for the majority of the club here, these bars will only grow, because even though the growth will speed up, the deficit will remain high, and there will be a prospect of spending more. And to have the economy rising, to have the economy growing significantly, you not only need to support demand, but you also need to support kind of conviction that it's going to last. And the things that kind of stand behind longer term decisions of consumers, but even more importantly of companies, suggest that we are not there, at least yet. On the right, you can see investment intentions in UK in the upper right corner, in US in the lower right corner, and you can see that even though there is some improvement compared to the spring, these indices are still well below their normal levels, which means that companies, which, as you saw on the PMI charts, they think, okay, the situation right now is great because there is stimulus, so we obviously can produce more, we can sell more, but longer term we are still very, very cautious. And here also this blue chart, it shows that in the US, while the employment in general recovered some of the losses from the spring, a number of longer term unemployed continues to rise, which means that basically a lot of temporary layoffs are being cancelled and these people return to work, but also at the same time many companies reduce workforce in a longer run. So these charts, obviously, they should make us a bit cautious about the longer term economic prospects. And what's the most interesting in all of this is what happens with inflation, where everyone assumes inflation will remain very, very low, and that will allow interest rates to remain at zero or around zero for many, many years into the future. If you think about market valuations, not only on equities, but pretty much on everything, bonds, gold, real estate, it all relies on very, very low interest rates. So markets are not so much worried about weaker economic growth, because if there is weaker economic growth, let's say next year, there will be conviction that central banks led by the Fed, they will buy even more of assets, and even though the economy may struggle, market participants will be happy. But if economic growth is okay, but if at the same time inflation accelerates like it did 10 years ago after the crisis ended, everything will be in trouble. And while this is certainly not the base scenario, it's not impossible. As you saw, companies are restrained in terms of investment decision making, in terms of long-term hiring, and some of them will not survive this pandemic crisis. So the supply side of the economy will be relatively smaller after this crisis. At the same time, all the stimulus will revive demand when economies reopen. If that translates into rising inflation, central banks will have hard time justifying their very, very aggressive monetary policies. And I think that this is something that needs to be watched, because, like I said again, next year is probably going to look great on paper. The economic growth will be there fueled by stimulus, fueled by reopening, but that's already discounted by the market. What's not discounted is the prospect of higher interest rates. While it's not imminent, it's something that traders are absolutely not prepared to accept, and that should have us on alert. So that's it from my side for today. I hope you enjoyed the presentation. We'll see each other next Monday, 7:30. Feel already invited. Have a good week.